Joining us right now with more is Erika Najarian, Managing Director, U.S. Large Cap Bank Analyst at UBS. Erika, what do you take away from this? And obviously, what everybody's trying to figure out is what this means about the future, not about the quarter we just saw.
Absolutely. So I think the conclusion here, it was a tremendous quarter for Wall Street and a question mark for Main Street. I think you saw the incredible trading numbers at JP Morgan and Morgan Stanley this morning, but you also saw that credit costs at JP Morgan were up to $3.3 billion. And Jamie Dimon and company built the reserve, the credit reserve, almost equally in the consumer and wholesale. And I think he was just out in the news media citing potential economic turbulence. So to your point, Becky, about looking forward, everybody's going to look at these results and say, that's great. The trading revenue beat at these companies had cushioned the capital for, future bad times. But what does the look forward look like? And if you think about investment banking activity, that was decent for Morgan Stanley and JP Morgan, but we were thinking about a capital markets renaissance this year. So the commentary on the activity levels going forward, I mean, how do corporations make decisions in this kind of environment, I think is really critical.
Yeah, Jamie Dimon saying the economy is facing considerable turbulence. We continue to believe it's prudent to maintain excess capital and ample liquidity in this environment. What does that statement alone tell you about the lending that the biggest risk managers are going to be doing to the lending they'll do to consumers and to businesses?
So I think that the banks are actually in good shape to continue to keep the spigot on. Becky, I think really what's happening here is a matter of demand. So the banks are extraordinarily well positioned that not only do they have great capital bases, but they have good earnings power because interest rates are at a level that's well above zero, outside of other, tougher times like, COVID and certainly the 10 years preceding that. I think what is really the issue here is demand. Corporations are not necessarily feeling like they should expand or act given they don't quite know the rules of the trade game. And you've seen the retail spending data. I mean, it's been not so great across the board in terms of either, luxury goods or, non-discretionary spending. And so it's really a matter of demand more than supply on the lending side.
I guess finally, I would ask what you think about the international business opportunities for these companies. Are they cut back? Which of the banks are most exposed to that? We've heard the EU say things like they're going to be looking at services because we don't trade as much physical goods with them, or they don't import as many physical goods. So, retaliatory tariffs may not work in the same way. If they focus on our big tech companies, if they focus on our financial companies, what's the exposure and who has the most at risk?
So if you think about all of the bulge bracket firms, they do business internationally in investment banking and trading. So it's the usual suspects, JP Morgan, Goldman, Citigroup, B of A, would certainly have international revenue exposure, particularly on the capital market side. I think at the end of the day, as we think about where growth has always really come from. It's really come from the U.S. capital market still, more than it has from Europe. And certainly, I think Asia has been a little bit more of a stop and start for the capital markets business for these bulge bracket firms. So it is definitely an underlying concern that is on top of all of the other, macro concern that is triggered by this trade war. But I think that, that part alone is not going to be as big of a deal as everything else. It's really going to be about whether or not the U.S. is going to slow down to a point where we're actually going to start to think about entertaining the R word or recession.